So hi, my name is Roy Thompson. I head up Carpenter Box Financial Advisors. With me, as always, is Henry Wilson, who's investment manager at LGT. Hi, Henry, how are you?
Very well, thank you.
There's been some significant investment market moves at the back end of last week. And as we start the beginning of this week, the 5th of August, so we thought we'd just get together just to film a short video to perhaps sort of understand why that might be and what the views, what the views might be. So, Henry, I think from reading things over the course of the weekend, the big thing that's driven the market sell-offs are really around some data that came through at the end of last week in America, which is, terminology that people would use is kind of spook the markets a little bit. Do you want to tell us a little bit about what that data is and what it really means?
Yeah, so I think just the backdrop first, I think is worth saying that obviously it's been quite a strong start to the year for equity market performance. So the US market has been up quite well, and in particular the tech names within the US have done really well.
Yeah.
And that's been the kind of backdrop throughout the year, is kind of the tech just going from strength to strength. And the underlying backdrop as well has been that the economy has been quite strong. So in the US, the economy has been trundling along at quite a good kind of level. People quite confident about the potential for no recession in 2024. On Thursday, at the back end of last week, two things happened. First of all, the Federal Reserve met and decided not to cut interest rates. And then after that, there was some data that came out that showed that the unemployment market or the jobs market was a bit weaker than people expected. This wasn't just a one-off data point. Actually, this was a succession of unemployment or employment readings that have come out over the last few months that kind of confirmed a trend of weakening in employment data. And what that caused is it caused a bit of a shock to the market because people suddenly became quite concerned about the potential for a recession. And people hadn't really been talking about a recession that much over the last few months. In fact, people were getting kind of actually a bit more optimistic. They were feeling that actually the recession was not going to happen. And then suddenly this jolted the market because it showed that unemployment had risen to 4.3%, up from 4.1%. And that there was generally just more softness in the economy than people had anticipated. So a bit of a shock, and people having been quite optimistic and quite confident, suddenly that kind of sentiment coming down. There are, of course, some other factors just worth kind of bearing in mind, which is just kind of course, you've had the backdrop of Iran and Israel and kind of geopolitical uncertainty, events going on in the US as well, with the kind of election coming up there, and Kamala Harris being the kind of likely Democrat candidate. But, a lot's been going on there. And then you've also had kind of in Japan, there's been events with the central bank there. The Bank of Japan has kind of surprised investors by doing an interest rate increase when people weren't expecting it.
So you talk about a recession. Of course, you mean a recession in the US. People are suddenly sort of a little bit more worried about the notion of recession in the US. You also said there that the jobs information, there's been a little bit more of a trend, but of course the figures last week were quite significantly below what the forecasts were, or worse than the forecasts were. Do you think that's kind of a unique 1 month point, or the fact that it's so significantly worse? Obviously, it's the summer. Jobs market can be more challenging around that time anyway. Do you think that plays into it at all, or do you think that this is now sort of a trend that's fairly well set, and that's the thing that's really caused the alarm? It's probably a bit of a big question, really.
Yeah, so obviously whenever you get kind of information that comes out, if you get a trend of things that kind of are all in the same direction, then that would kind of help inform our views. But what we think with this one is that while it is part of a trend which shows some weakness occurring, one of the things that was unique about this data point, or this recent employment report, is that it did show a lot of people that are out of work on a temporary basis, and some of it is related to poor weather, so hurricanes and poor weather, and that number at the moment was abnormally high for this month. So that might indicate that actually, when we get the next reading, which will be next month, that figure might have actually improved materially when that comes out. So our main thing is we're not panicking. We're actually saying, look, we understand that there is a picture that is emerging, but we're not panicking because there is some stuff that is quite unique at the moment, and that might correct itself the next data point. So basically, don't panic, keep going with what we're doing, and let's continue to monitor the future data that comes out kind of late August, September time.
Mm. And I think that's probably quite important from an investor's perspective. People listening to this might see that their portfolio has gone down in value because investment markets have gone down, and that there is sometimes some concern in that scenario, which is completely understandable. What you're sort of almost intimating is outside of that jobs information, which is important. But outside of that, some of the earnings coming through have not been too bad. There's been a mixed bag for most of the year, actually. And some of the other economic data, such as GDP in America, so the growth of the economy still is forecasted as being quite strong. So, yeah, what you're sort of intimating there is that it's not time for a wholesale change just over the space of 2 days, but it is something that we need to make sure we're monitoring.
Exactly. I mean, look, when markets move this much, you can get kind of swept up in the emotion of market falls. But one thing that we note is that just last week, the Fed came out and they did a meeting and they said that we're quite comfortable with the state of the economy, and that's why we're not cutting interest rates. If they were worried about the state of the economy, they would have cut interest rates. Number two, we've been looking at data throughout the last, we look at it all the time, and actually the data is consistent, we believe, with what's known as a soft landing, which is that there is a cooling off of the US economy caused by higher interest rates. And what we're seeing is consistent with a cooling off, but it's certainly not a crashing of the economy. And so kind of ignore what's going on in the markets and just focus what's actually the hard data that we're seeing, which is a slowing down, but nothing too material or nothing too concerning.
And it would be interesting to see how that plays out. But certainly you as a company then would be sort of monitoring that on an almost daily basis, just to sort of make sure that the announcements that are sort of coming out, the data points that are coming out over the course of the next, let's say, working week or two, or not showing further signs of further weakening in the economy, or enough to change your viewpoint, I guess.
Definitely. And our view at the moment really is probably more consistent with the idea that if we see further falls, what we'll probably do is we're more likely to dip our toe back into markets rather than, i.e., we're more likely to invest a bit more into risk than to sell or change our investment strategy.
Yeah. And when you say risk, you mean equities or shares rather than more secure assets such as government bonds, for example. So
correct. Yeah.
You mentioned also about Japan. So Japan seems to, or the Far East Asian market seem to have had a particularly poor reaction to it. Is that linked to the fact that there was the surprise interest rate increase in Japan, do you think?
Yes, so a few bits going on in Asia and Japan at the moment. One of them has been, obviously, there's been a fair bit of discussion about China and kind of political stuff going on there, and in terms of the overall growth, which has disappointed a bit this year. But what was really noteworthy in Japan recently is the Japanese market's actually done very, very well up until the last week in terms of stock market returns. But what had happened is that the currency had been quite weak. So as a sterling investor, you hadn't seen that much of the return. Now, what happened is last week, the Bank of Japan came out and surprised investors by raising interest rates quicker than people expected. And so what's happened since then is that the yen has appreciated. It's risen quite aggressively versus sterling. And the stock market has given up some of those returns. As a UK investor, what it means is that even though the stock market has fallen, because the currency, the yen, has strengthened versus sterling, it hasn't impacted our portfolios as badly as it would have done.
But and you might argue going forward the same thing. That if you have a fundamental belief in the region, then you may look at increasing exposure.
Yes, exactly. I mean, we kind of today we've looked back at a lot of our data and we've kind of reinforced our view that when it comes to Japan, what we were excited about just a week ago remains stuff that we're still excited about going forwards. We're seeing structural reforms there. We're seeing an economy that's growing at a fairly decent lick. We're seeing some great quality companies at fair valuations. That hasn't changed. So we continue to be excited about the region, and we might dip our toes back into Japan. We might add a little bit more. We're not there just yet. We'll continue to see how things evolve over the coming days. But what we would say is that some of the moves look a bit disorderly or irrational at the moment in Japanese equities.
So it's interesting. Obviously, different investment managers might look to tackle things in a different way, but what you're really saying at the moment, that if you're an investor, yes, there's some emotional ties to the movements that you might see in the value of your portfolio, but it's about trusting an investment manager to ensure that they're monitoring the market and not to just simply react to what's going on today, yesterday, make big sell-offs or big changes to your overarching view, which is more based upon fundamentals and would hopefully lead to decent long-term returns.
Definitely. This is the thing, is on days like this, you've got to remember that investing is a long-term game.
Yeah.
And often it's these market falls that create very good long-term opportunities to increase your wealth. The market has a funny thing of shooting first and thinking later. It just
Yeah.
moves and it's irrational, it's exuberant, it can be over the top, and it's about sticking to your knitting and realizing that actually, has the fundamentals changed in what we're doing here? No, nothing really has changed. We still remain quite confident, quietly cautious, sort of cautiously optimistic with the underlying economy. If things do change, we obviously have the ability to change the portfolios and adopt a slightly more defensive stance. But for the time being, actually, we're seeing some quite interesting opportunities emerging.
Okay, that's great. Thanks very much, Henry. I really appreciate your
Thanks so much,
time
Roy.
today. Thanks very
Cheers.
much.
Bye.
Take care. Bye.
Thank you for watching this video by Carpenter Box Financial Advisors. For more information, visit our website. Or for more videos like this one, please like and subscribe.